Hello and welcome again to another edition of Analyst Insight. You know that on this program we are talking about everything finance, business, and investment. Our interest obviously are our local capital markets. So once again for this week we've got a lot of things to discuss around our capital markets. And as usual, I'm joined by my colleague Rufaro for this program. Rufaro, welcome to Analyst Insights.
Thanks for having me, Ranga.
Good. So there are a couple of issues that we're going to discuss about. I think the first one that affects all of us is the recent increase in the price of bread. So it now costs about 210 Zimbabwean dollars. So at official rate or at the auction rate, that's about $1.85 US dollars. So maybe the first question that I'll pose to you, what does that mean? Our bread at $1.85, how does that compare with the rest of the region? Or is it that our bread is now more expensive, or there's something that is wrong with our exchange rate? Which is which?
So I think that's bread is a classic basic commodity that almost everybody consumes, not only in Zimbabwe but across the region. And I think at $1.85, it's it speaks to an overvaluation of the rate at the auction. Because I think everybody remembers what the US dollar price of bread used to be when we were in a US dollar era. So I think bread is the perfect example to have the discussion about whether the auction rate truly reflects the value of our currency. And if you actually apply the power market rate instead, you'll find that the US dollar price of bread it then becomes comparable to the rest of the region. So if you use, for example, a rate of 200 for argument's sake, then it's closer to $1, which is where which I think most observers would agree is closer to fair value. So I think the significant discount we're seeing on the auction rate to the power market rate speaks to it lagging where it should be. And we hope that perhaps this discussion about the bread price percolates to the powers that be in terms of setting where the auction rate is and encourages them to close that gap.
And talking about the auction market, the market resumed its activities this week. So there's been a lot of speculation after that break of almost 4 weeks as to when the market was going to be opened and the reason why it was closed at that point. And yeah, surprise, on Tuesday, we saw that one pager which was telling us the rate was now above 110. So what are you expecting this year in terms of the activity on the auction market, even in terms of the rate? Are you expecting that gap to narrow, to widen even further? And how can it be best used to actually resolve some of the challenges that we were talking about, where we are not sure whether our bread is $1.85 US or it's 90 US cents because of the differences in the rate?
So I think it's that's a very difficult question in terms of how to make predictions about where the auction rate will go and how it will behave for the rest of the year, because on paper the auction is a market in which willing buyers and willing sellers interface and set a rate, but in reality it's a managed exchange rate. We have the authorities that essentially or dictate what the rate is, and they do not speak to their methodology in terms of arriving at a particular rate, and nor do they give us any guidance in terms of what policy action they're going to take with the rate going forward. So it's a black box. We have no idea. All I can say with high conviction is that what will happen on the power market and with inflation is a function of deficit spending by government and money supply growth by the government. So to the extent that we continue to see the trend that we saw over the last quarter of significant deficit spending and money supply growth, we will see significant inflation, and we will see significant further devaluation of the local currency on the power market rate. And I think that government seems to be alive to this, because you've got COVID allowances that are paid in US dollars. You've got $50 a week available to the public at the auction rate. So if I was to guess out, I suspect that this we are going to carry on being a dual currency economy with a significant part of our economy trading in US dollars and the rest of it in Zim dollars.
So perhaps it's a good spot for us to discuss developments on the mining sector, for obvious reasons that it is the mining sector which is a major supplier of our currency. So most of the currency that we see, that we are bidding for on the auction, is actually coming from the mining sector. And we woke up to the news that 2021 was such a good year for the gold subsector, with output jumping 56% to just under 30 tons of gold. What do you make of that? And what can we expect in 2022?
So I think that's what we saw happening in the mining sector is very positive. We have increased deliveries. Globally, we're seeing commodities boom. A lot of commodities are trading at all-time highs or near the all-time highs. So our mining sector benefited, and we were also lucky in that we had a good rainy season after a drought in 2020. So we had significantly more grain production, and our agricultural output was better. So these were positives, and all things being equal, you'd actually expect that with significantly higher export proceeds and less imports of grain, our currency would have been stable or strengthened. But it just speaks to the extent of deficit spending and money supply growth that, notwithstanding this fantastic performance in mining and agriculture, we closed the year on 60% official annual inflation. And if you look at the power market, the dollar basically lost, it devalued by almost 100%. So that's massive. And so because it seems that the government is able to overwhelm the market in terms of its impact on inflation and the value of the currency, in spite of any positive developments in the export sector. So going into looking forward into this year, the mining sector, the commodities boom is set to continue. So the mining sector should do well. The rains were late, but we may salvage a decent agricultural season. But I think the X factor is, to what extent are we going to see significant deficit spending and money supply growth? That's really going to tell us, that's really what will decide how the economy performs this year.
Okay, so to our viewers, maybe we may want to share with you just a few nuggets. Our gold is actually produced by two sort of subsectors of the economy. So one of them is your big corporate mines, and then you've got the artisanal mines as well, the macrocosas. So ideally, over the years, the output from your big corporates has generally been stable at around 10 tons of gold a year. And there's been variation in terms of the gold output that was coming from the artisanal miners. So last year they contributed almost 19 tons, and the contribution from your big corporate entities still remains the same. And looks our peak period, our peak production was in 2018, where we produced about 35 tons of gold, and still the biggest part of that has been coming from the artisanal miners. So given that kind of scenario, Rufaro, what do you think we need as a country to make sure that we have got consistent supply of deliveries from the artisanal miners? The mining corporations, their deliveries are consistent at around 10 to 11 tons. And whenever you see our global numbers coming off, like they did the year before last, it was because of reduced deliveries by the artisanal. What do you think needs to be done so that we have got a consistent deliveries from the artisanal, and maybe just grow our numbers?
So I think it's a function of the exchange control regime. So for as long as the artisanal miners feel that they're getting fair value from Fidelity, they will that will be their first choice in terms of deliveries. But once they feel that they're getting a significant discount at Fidelity, then that creates a massive incentive for them to smuggle the gold out instead of delivering it through official channels. And then this is when we see fall off in deliveries. So I think the best way to encourage deliveries to Fidelity is to have an exchange control regime that is fair to the exporter. And the reason why we don't see significant new investment in the corporate sector is because when they look at the regulatory environment, they do not have confidence that they will be able to recoup their investment and make the return that they're looking for. So if we changed the policy framework and we created certainty and confidence, then you would see significant investment from the formal sector, and I suspect that the deliveries from the artisanal miners would also grow significantly.
So talking about changing the policy framework and also improving certainty, I think the other issue that one looks at is what has been happening in the chrome subsector. So we saw a policy to ban the export of ore, and that we should prepare for an effective ban of concentrate by July of this year. Smart or dumb? What would be your response to that, and why do you think they are taking these kind of measures?
So the idea is obviously to encourage investment in beneficiation so that we build smelters here and we process our ore all the way to actual chrome that we then export and get higher value for. But I think the banning chrome is not going to necessarily produce that outcome, because the reason why the market hadn't already, we didn't see investments from people in the sector to beneficiate the ore all the way to the final product, is because of the current exchange rate regime. Those who have the capacity to make the investments simply don't have the confidence that they will get the returns that they're looking for. And banning export of the ore does not actually solve that problem in terms of engendering confidence in the sector. So I think so what you'll find is, and the mining the ore and actually smelting it are probably different skill sets, and what this policy ban does is it hurts the miners and doesn't necessarily build the confidence for the investments in smelting to happen. So what will happen in the interim is that the miners are going to suffer. They will not be able to generate revenue. They're going to shut down their operations, and it will be a net negative for the chrome mining sector. I think a wiser policy initiative would be to actually create incentives for those who would invest in smelting to do so, whether it's through retention policy or tax incentives or other incentives. Then you would find that the investments would come through on the smelting side without hurting the miners.
All right. So still on the subject of gold, I think a very common question that you come across with is as we are seeing these good numbers in terms of output, 30 tons. Um, what needs to be done in our local capital markets for the investment public to start benefiting from or participating or having an exposure in our uh, gold subsector? Because like right now, when you look at the Zimbabwe Stock Exchange right now, you won't be able to get any meaningful or decent listed gold mines. Okay, you can talk of Rio, but I think the bigger gold mines or uh, the ones that are showing good growth are probably not listed there. Uh, as a seasoned capital market player, what do you think needs to happen in this market for that to start coming through? I know there is Caledonia and the listing of their DRS that they've done on VFX, but what more can be done for our gold sector to actually come into our capital markets and start being a meaningful um, area that one can look at for investments?
So I think Caledonia is listed as well as Padenga on the VFX. So those who have access to foreign currency or nostril balances can make investments there. And I think the other thing that's probably worth considering for Caledonia and Padenga is to also have an instrument listed on the ZSE that is available to investors in the local market who do not have access to foreign currency to be able to invest on the ZSE. So that's probably a product that is worth thinking about, that will make that will improve the liquidity of those two gold stocks on the VFX in Zim by having an instrument on the ZSE as well.
And maybe our last issue for this episode is just looking at the Delta trading update. Um, um, and maybe when you saw that trading update, what are some of the key takeaways, and what are your expectations in terms of the performance of Delta? Like in the marketplace is actually deemed a barometer of things that are taking place in the economy. With what you saw on the trading update, are there any issues that pop out that you think maybe they are worth talking about?
Yeah, so Delta is considered a proxy for Zim GDP because it speaks to aggregate demand, and they did see significant growth in their volumes and profits. But we've got to take that in the context of those numbers coming from a low base in 2020, where we had significant periods under lockdown, and the consumer simply could not go out and work and make a living, and therefore their consumption declined quite a lot. So I think that this year will really speak to what levels of consumption are normal if we don't see significant lockdowns or restrictions on account of COVID. So I think Delta will be a close one to watch in 2022. But just just looking at Delta as a blue chip and representative of the market in general, I think they had a fantastic year in 2021. It's unlikely that they'll be able to repeat that performance this year. And I think that so anybody looking at Delta and other stocks on the market this year should be much more sensitive to valuations.
Thanks so much to Faro for sharing your views with us, and to our viewers. That's all we had for you this week. We hope that we have provided you with important information that you need. As you know, when you are playing on the capital markets, information is actually a very important product. So you want to be able to make investment decisions based on the information that we have, be it macro, that's talking to the economy as a whole, or micro for specific companies. So thank you very much for watching. Remember to subscribe to our YouTube channel and to like our page, to comment on our different platforms, and because we want to hear from you. We meet you again next time. Otherwise, bye bye for now.